Thank you everybody for joining us today for this live flash talk about what's next for China's economic policy. My name is Andrew Polk, co-founder of Trivium China, former head of our markets research, but still work closely with our new head of markets research, Jenny McMahon, who is joining me today. Thanks, Jenny, for taking the time.
Pleasure as always, Andrew.
So we are going to walk through a few things today in terms of kind of where we are in the overall economy, what policy choices have been taken to date, and then we'll look at after we kind of establish that what's next with this upcoming sort of season of important economic policy meetings and what people should be watching out for. I think I'll just give the bottom line up front, which is a lot of folks are still expecting another shoe to drop in terms of significant new stimulative measures. And we do not think that such moves will be forthcoming. We think largely that officials have set forth a path and at least for the next quarter, or potentially two, we'll be looking to see kind of how that policy prescription is playing out before any major moves are made. And we'll kind of get into some of the reasons behind that. But for now, the framework of, well, when are they finally going to do the big stimulus is just probably not the right framework to be thinking about. Because if they were going to do it, they already would have done it. And so that's just an important thing to talk about up front. But before we get into the policy piece, I just want to talk a little bit about, China's economy has become, at least in Washington, D.C., China circles, the topic du jour, really over the past few weeks. Just, I'm sure many of you have seen lots of talks and panels on this issue. I've been a part of some of those. And so it seems to have kind of coalesced in Washington that this is a big issue. And I think some of that was driven by, very public writing, both in the media and otherwise, about, kind of the end of the China growth miracle. Peak China has passed. There was a piece in Foreign Affairs by Adam Posen at the Peterson Institute of International Economics saying, the China growth miracle is over. George Will wrote in the Washington Post, I believe, about China's Leninist problem. And I think that just focused a lot of minds on, oh, okay, that this something really deep is going on here. And in my view, I think it's that sort of public narrative, jump the shark is the wrong word, but kind of has swung a little bit too far. And I think the issue with that kind of analysis is that it's really premature to an extent, and that it's kind of proclaiming the China model dead, and it's assuming that 90% or even 95% of what we're seeing in China's economy now is structural, that structural things are totally broken, not working, and that China can't pull out. And it is true that China has significant structural headwinds to growth and challenges to the growth model that has powered its economic rise over the past 40 years. But I would say that in the balance, probably the breakdown's more like 50% of it is structural and 50% of it is cyclical. So large chunks are structural challenges that the Chinese economy is facing, but some of it's just sort of a cyclical downturn kind of on the back of 3 years of COVID. So I'm going to walk through a little bit of that, and then we'll get into the policy prescriptions. So on the structural side, undoubtedly, the adjustment in the property market is a structural development. There's debates out there as to how purposeful the property adjustment has been. Did policymakers do this mostly intentionally, or was this kind of something that they couldn't stop from happening? My view is that it's some of both. That certainly some intentional decisions were made to not stimulate the property market as they have in the past, to take a different approach and to allow some sort of adjustment. I think, if you asked any Politburo member last year, or even in the past few years, should property be 30% of total value added output or GDP in the next 5 years, they'd all say no. And so it was always clear that adjusting the property market's overall relationship with the economy was going to be, painful. And yet they have made some purposeful decisions to allow that to happen. I'll get back to where we are in that cycle when I talk about the cyclical aspect of it, but a big chunk of that structural adjustments really taken place now over 2021, 2022, and most of 2023. Another big structural factor is demographics. Of course, China's demographic slowdown, means, or demographic aging means you have more and more old people who are supported by a smaller and smaller working age population, and that's been the case now for many years. I think the working age population officially, depending on how you define it, started shrinking or peaked in 2013. So it's been about a decade. So that's another structural piece. But also, we need to look at the cyclical side. So I think it's undeniable that China's economy is currently growing below its trend growth rate or its potential growth rate. You see that in very low inflation, both on the consumer side and currently upstream prices, flirting with some deflation, and seen deflation in the past few months, but are likely starting to pull out of that. That's a sign that the economy is growing below its trend. And so importantly for both investors and companies looking at China and trying to make longer term decisions about capital investment, capital allocation, it's important to note that we're not just now on this inexorable, suppression and growth. Yes, China's trend growth rate is on a soft decline, but the current moment where it seems like everything is totally terrible in China, some of that's just weak cyclical activity on the back of COVID. The primary cyclical piece that could start to see some improvement in the months ahead is consumption. The PBOC and other officials have said, that in their view, economies have taken about a year for consumers to come back after kind of a COVID, policy lockdown or COVID policy disruption. So they estimate that we're basically, by this point, about 3/4 of the way through what they call household balance sheet adjustments. What they mean is Chinese economists often talk about how household balance sheets were damaged throughout the pandemic. And what happens when household balance sheets are damaged is people start to have less confidence in the future. They have lower income growth. Their wealth is not growing as rapidly because particularly property values are not growing as rapidly or even declining. And so people start to save more so that they can have more of a nest egg and build up their balance sheets before they start consuming again. PBOC reckons, that's the central bank reckons, we're about 9 months through that period of adjustment, and then it's a 12-month, it will likely take 12 months. So we may be starting to be hitting the bottom of consumers and households making those adjustments. And I think part of the challenge right now, as people look at the China's economy, is usually you have this big stimulus when growth falls. The cycle turns quite quickly, and this time officials have taken a more, explicit approach to just kind of let the adjustment happen on its own. And households do adjust, right, through that process that I just talked about. And when I was in Beijing in July, so a few months ago now, you could almost feel that people right-sizing their lifestyles, going out to lunches and dinners, less frequently, trying to, buy fewer, gadgets and things like that. And so that process is taking place, and we should be near the end of it soon. Second piece on the cyclical that we could see some upside in growth in the months ahead is on infrastructure investment. So special purpose bonds are local government's main vehicle for financing infrastructure investment. And the central government required the entire quota of special purpose bonds to be issued by the end of September. So just a few days ago, those all got issued. And now there's a big chunk of money that local governments will start to deploy into local infrastructure projects. So we could see uptick in infrastructure spending through the end of the quarter as well, which could add to a cyclical improvement in growth. Thirdly, property. So like I said, that's both structural and cyclical, but we've adjusted so far in the property market that activity looks to finally be bottoming out. Um, a lot of the housing projects that were meant to be completed are starting to get completed. Once those are done, developers may have more cash on hand to finally start new starts. And so we're in early days, but starting to see the bottoming out potentially of the cyclical part of that property adjustment as well. So there's a difference between the primary market and the secondary market. What we're most concerned with is the primary market. When will developers start building again? Because that's what actually drives economic activity as opposed to the secondary market. So even some slight green shoots on the property side, then eventually, and this will take a few more months, exports will pick back up. The renminbi has depreciated significantly this year. It's trading at 15-year lows. Eventually, that helps to support exports. And so this will likely happen more like 2-3 quarters from now, but 2024 could see some support from external demand in China's growth. So all that is to say, I just caution people not to overread the moment where China's economy is in terms of the growth model's dead. Yes, there are some structural challenges holding back growth, but we're about to see some cyclical tailwinds we think are starting to see the bottom of the cyclical downturn, and that we'll start to see improvement towards the end of the year and into 2024. So in a way, there is some positivity to be seen in China's economy. Given that, I just want to say that part of the reason the adjustment's been extended, as I said, is policymakers haven't brought out the big bazookas. They've taken a much different approach. So before we talk about what's next for policy, I want to hand it over to Denny to say, okay, we are where we are in this cycle. There are structural factors at play as well. But what have we seen so far this year, particularly in the past 2 or 3 months on the policy side? What is the framework that we're currently dealing with? And sorry, before I hand that, there's sort of 3 aspects of that. Primarily supporting consumption, trying to do some things in the property market, and then most recently efforts to try to alleviate the most extreme pain points on local government debt. So let's start with consumption. What are you seeing there?
No, absolutely. So in terms of what's happening with consumption, is at this point, Beijing has a very clear approach to trying to revive consumer spending. And it's a two-pronged approach. On one hand, they're trying to revive latent demand. Now, we've talked about this and written about this at great length. The idea is that there's a whole lot of structural barriers standing in the way of people consuming big ticket items, things like cars, electronic goods, furniture, whatnot. And Beijing is trying to remove the barriers to them consuming. It's a long-term strategy. It's not the sort of thing that kind of can turn consumption on a dime, but that's the sort of measures to unleash that latent demand. It's the sort of stuff that we saw early on in efforts to revive consumption, April, May, June, July. What we've been seeing in the last month, in the last 2 months, is kind of the other prong. And that is focused very much on trying to put more money back into the pockets of households. Now, this is something that authorities have been talking about since December, when they first put consumption at the center of the economic story this year. They've been saying that we need to use multiple measures in which to raise household incomes. The economic planner, the NDRC, has said it. The Politburo has said it. Now, I think a lot of people thought that might translate into kind of direct redistribution measures on the behalf of the central government, the sort of thing that we typically see in developed economies. But I think it's pretty clear at this point that Beijing is not going to go down that road. Xi Jinping has kind of taken a fairly strong position against what he perceives as being welfarism, which we think is kind of being sort of large-scale redistributionist policies. So instead, they're kind of trying to use these market-oriented efforts to boost household incomes. And the most significant one we've seen so far is this move by the PBOC to push banks to cut the interest rate on the existing stock of mortgages. So for various reasons, people who have a mortgage in China, despite having their mortgage rate reduce every time the PBOC pushes down the benchmark or announces a reduction in the benchmark, the full extent of those reductions typically haven't been passed on to existing mortgage holders. Now what the PBOC is doing is it's telling the banks to effectively give existing mortgage holders the minimum mortgage rate to which they are entitled to. Now, What that will mean across the system in terms of the size, the average weighted size of the cut, we don't really know. But this is not a mechanism designed to boost the property market. This is very much explicitly a measure designed to reduce the monthly mortgage payment burden of households, such that you put more money into their pockets and hopefully they will spend it. Of course, the big question is to how much of that windfall they'll save and how much they'll spend. But nonetheless, this is the direction of travel. We've also been seeing it in recent months.
Can you discuss some of the specifics there? Just quickly how that mechanism works? So typically, and I'm just going to channel Denny here for a sec. Typically, the way most mortgages in China are adjustable rate mortgages. Typically, any adjustment that the central bank makes in its benchmark interest rates, which mortgages are priced off of, don't really feed into the actual mortgage payment process until January of each year. So they're adjustable rate mortgages that are adjusted once a year. PBOC has been cutting rates, but since the banks don't usually adjust the rates until the beginning of the next year, consumers haven't actually seen lower interest rates on their mortgages. They effectively haven't been able to refinance. What the PBOC has done is said, you guys go ahead and refinance those now. And so that brings down the interest rate on your existing mortgage in a more timely fashion. So you see the pass through more quickly, and it immediately starts to affect the actual size of your monthly mortgage payment, which then puts money in your pocket that you hopefully then go spend rather than spending it on your mortgage. Of course, you could save it. And if that happens, that has less of an impact on consumption. But just wanted to walk through some of the mechanics there. Denny, let me know if I got any of that incorrect.
No, you got most of it correct. But there's something else going on here as well, is that the benchmark mortgage rates have been declining for the last few years, right? And although you're right, all of those cuts were supposed to be passed on to consumers, to mortgage holders on the 1st of January each year, for various reasons tied up into the sort of the details of the contracts that individuals sign with the banks weren't passing on those cuts in their entirety. So over the last few years, even as mortgage rates have fallen, the minimum benchmark as mandated by the PBOC has fallen this much. A lot of people have only seen their rates reduced by this much. And now the PBOC is pretty much telling the banks, you got to go the whole way. But anyway, the upshot is exactly what Andrew was saying. All of a sudden, people are going to receive a monthly windfall when it comes to what they're paying month on month to the banks in terms of mortgages. And the vision here is that it will stimulate consumption. The other consumption measures we're seeing are cuts to income taxes. Now, these are probably less meaningful. Of course, this would be the main conduit through which to kind of boost spending in a developed economy, but a relatively small portion of the population, probably less than 10%. The best estimate I've seen is somewhere between 5 and 8% of the population actually pays income tax. And so trying to provide income relief through the taxation system isn't as effective. And the last significant change we've seen, and again, this has only been in the last month or so, has been efforts to revive the A-share market, China's domestic stock markets. Now, this was flagged at the last Politburo meeting on the economy at the end of July, when the authorities say they want to enliven capital markets. At the time, no one really knew what that meant. But by the end of September, the securities regulator, the Ministry of Finance, they started rolling out measures to effectively do two things: to kind of reduce the cost of trading A-shares and also to stimulate demand for A-shares, doing things like pushing companies to engage in buybacks. Now, the whole point of this sort of raft of measures was to kind of be a clear signal to the market that the government is backing stronger A-share valuations, and the hope was then investors would take that signal and kind of plow in now in anticipation that prices would rise because of government support. Now, of course, so far it hasn't been hugely successful, and there might be various different reasons for that. However, the other question is, what is the government trying to achieve here? Because yes, A-shares have been declining, but in they haven't declined as much as previous instances where the government felt compelled to intervene to kind of stop the rout of the market. It hasn't really been that bad. So there has been an open question about what's going on here. And we see it as being explicitly linked to Beijing's desire to boost consumption. And the reason we say that is kind of halfway between the Politburo meeting, in which they said they wanted to enliven capital markets, and finally when the regulators started rolling out measures. Halfway in between, there was an essay, a commentary from the Economic Daily, which is the party's the party's broadsheet or mouthpiece on economic issues. And it said explicitly that firstly, A shares are undervalued. And secondly, the path to reviving consumer confidence and boosting consumer demand is through higher A share prices. And the reason it said that is that if the market starts rising, then people will feel more confident about their wealth and people will have more money in their pockets and they'll start spending again. And we think the vision here was that, given that so much household wealth is tied up in the property market, and so far the property market hasn't come roaring back, even if we see signs that the market is starting to recover, we're not going to kind of see that sort of massive acceleration in prices, which kind of really buoyed household expectations about future wealth in the past. So perhaps the other conduit here is, and perhaps the more effective conduit, is to kind of boost A share valuations to kind of support household wealth. So that's kind of the other mechanism we're seeing. So far, it hasn't been hugely successful, but crucially here, it speaks to the approach that Beijing is trying to take. It's not about outright redistribution, about using fiscal resources to boost household incomes. It's about using these other mechanisms, ideally more market-oriented mechanisms, to kind of boost household wealth. And we expect to probably see more efforts by Beijing to kind of support A shares and kind of stick with this for a little while. But anyway, that's what's happening with consumption at the moment. It is those two prongs, and it is a fairly uniquely Chinese approach to kind of reviving consumption. They've only been at this maybe for less than 6 months. And so we expect they're probably going to stay the course on this approach for quite some time until they feel confident one way or the other as to whether it's been a success.
Great. Well, thank you for that. And before we go into the property and local government debt pieces, I just want to say quickly, the reason we're spending extended time talking about the current policy framework is it's really important to understanding what's next. They're really setting the foundations for what they're trying to do. And also, I just want to let everybody know that we're going to try to keep the comments to about 40 minutes and then have some Q&A. So you can feel free to put your questions in the Q&A anytime, but we will open it up here in a little bit. So before we do that, so we talked about measures to support or boost consumption. What has been done on the property side to try to stabilize the market there?
Over the last month or so, we've seen a lot more focus on just dismantling various restrictions that were put in place mainly between 2015 and 2019, or 2016, 2019, that were designed to rein in the rapid price appreciation that China's housing market was experiencing at the time. And so those measures are primarily designed to prevent people acquiring investment properties. It was about shrinking the pool of potential buyers in housing markets. So outsiders, you had to kind of be a local to buy into your local market. So it was a smaller pool of potential buyers. And it was about, hey, if you'd already bought a property, then your second, third, fourth properties were going to be a lot more expensive for you to buy in terms of how much credit you could access and at what price you could borrow it. And so they're the sorts of restrictions they've been dismantling. Of course, it's happening at a different pace and to a different degree in different cities. Shanghai, for example, still seems fairly reticent to remove restrictions too aggressively because probably with good reason. There is a sense that demand for housing in Shanghai, as a sort of given the role that city plays in the Chinese economy, and as kind of a beacon for internal migration, that demand there will be strong indefinitely and forever. But certainly in smaller cities, second and third tier cities, we've been seeing those restrictions being dismantled fairly aggressively, if not throughout the entire cities, and certainly outside of the core of those cities where housing demand is strongest. So that's where we are at the moment. I mean, these are a kind of the stage we're at the moment. It is dismantling of policies that were put in place to deal with a very specific problem, which was rapid price appreciation, that is clearly not the problem, no longer really have any relevance whatsoever to China's contemporary property market.
And so the goal there, just so people, just to put a back out a little bit, is really to unlock kind of marginal demand, right? People who actually still do want to buy in this market, but for various reasons were unable to. For some people, it's lowering mortgage rates is allowing them to jump into the market at a time when they may have been wanting to buy, but kind of things were a little bit too expensive. And then for others, it's allowing, for example, migrants who want to buy a home in the city where they work, they're now allowed to. Some people can buy a second apartment for more cheaply. Another thing that was done was if you had previously bought a house and paid off the mortgage, even if you didn't have a mortgage, you were still considered a second home buyer. And so there's some adjustments there so that those individuals can now be treated as first-time home buyers and get cheaper mortgages as well and more access to purchase properties. And so it's really about unlocking some marginal demand, which we do think will give a boost to housing demand, but it'll be short and it'll be temporary unless they do some more aggressive pieces on that down the line, which we can talk about in the kind of what's next section. Finally, local government debt. What are we seeing on that in the past couple of months?
So again, at the Politburo meeting at the end of July, Politburo flagged first time this idea that they were going to roll out a basket of measures for dealing with the risks associated with local government debt. Now, so far, the only specific measure that we've seen introduced, and again, this wasn't the government formally announcing it, it's been sort of leaked through Bloomberg and Caixin, that the Ministry of Finance has allocated a quota of somewhere between 1 trillion RMB and 1.5 trillion RMB of special purpose bonds that 12 provinces, the most sort of over-indebted and financially stressed provinces, can issue effectively to buy back debt issued by local government financing vehicles. So it's effectively a refinancing mechanism or a debt swap mechanism that it allows for the migration of what up until now has been debt held by local government financing vehicles, and that debt is now migrating explicitly onto the balance sheet of local governments. And the rationale here is that, because of a quirk of China's system, local government financing vehicles were tasked with funding the construction of public works that under any other system would have been funded explicitly by local governments. However, what that means is that local government financing vehicles were paying higher costs to fund that debt. The interest rate on their borrowing was higher. Now, it makes sense for that debt to be now placed explicitly in the hands of local governments who can fund it at a lower cost. So the whole point of this exercise is it is about reducing the funding costs of local government debt. Now, this isn't the first time that we've had this sort of refinancing bond mechanism. There have been 3 other programs that have been run over the last 3 years for different levels of local government. A couple of years ago, some of the most economically prosperous provinces were able to do this, such that Guangdong province said that now it doesn't have any hidden debt left. Beijing says exactly the same thing. It's been able to buy out a lot of the debt that that the local governments were explicitly or implicitly responsible for, that were being held by LGFVs and other state firms. And now we're kind of dealing with the debt held by more distressed provincial governments. Now, the IMF estimates that there's something like, was it 66 trillion renminbi's worth of local government debt, or was it LGFV debt? The point is there is a huge amount of debt which is still floating around, which the local governments are on the hook for, but doesn't exist or isn't recognised explicitly on their balance sheets. 1 to 1.5 trillion barely scratches the surface. However, this is a mechanism that's only kind of been rolled out for the last 4 months of 2022. The reason the quota is so small is because it is taken from the quota of unused special purpose bonds and general purpose bonds that local governments have accumulated in recent years, but they haven't issued yet. So this is effectively, it's the Ministry of Finance being able to allocate local governments a bond quota without having to go to the National Parliament, to the MPC, and asking for an increase in local government debt, right? They're using kind of a leftover quota. It's almost kind of a loophole. So that's kind of why the quota is so small. But what it means is that the authorities feel that this is going quite well. Then in the new year, when the NPC sits, the Ministry of Finance can ask for a more robust quota to try and push this, this refinancing, this debt swap mechanism further. So that's kind of where we are so far. That's kind of been the only explicit item that has turned up in the Politburo's basket of measures. But at the same time, we're hearing the central government talk more about the need for local governments to sell assets, which we assume to mean selling equity in state-owned firms as a way to kind of pay down debt and get their finances under control. And the other big thing turned up in a Caixin story, saying that the PBOC is considering setting up some kind of special purpose vehicle that will allow it to reduce the cost of LGFE funding and extend the maturity of their borrowing. Now, we're not exactly sure what that will mean exactly, but in the past, when the PBOC has set up a special purpose vehicle, and often this is how it works with other central banks elsewhere in the world, is that they do it because they cannot hold corporate debt directly. And so they use an SPV to do it instead. Now, that might be signaling then that the PBOC intends to either buy LGFE bonds directly or perhaps buy LGFE loans directly from the banks. Now, might that then put the PBOC in some ways of kind of being a buyer of last resort for LGFE debt? Will that then help kind of put a sort of a floor under how much the value that bonds can fall? Will it kind of help keep interest rates on these sorts of LGFE debt low? We see that could be the motivation here. Of course, we don't have any details at the moment, but this could be an incredibly interesting development. How the central bank will mobilize its own balance sheet to deal with the local government debt problem, because based on that Caixin reporting, finally that piece of that aspect of government resources finally seems to be put in play. But that's where we are at the moment. The big thing at the moment has been the refinancing bonds. We expect to see something involving the PBOC in the near future. And of course, there's this question about whether local governments will start selling off assets to be able to more adequately manage their debt.
And just for some context, I think the PBOC has even referenced this. The Federal Reserve, the U.S. central bank, during the pandemic, did a very similar move. It set up a special purpose vehicle to buy commercial debt for particularly small companies, right? It also is prohibited from holding corporate debt. And so it set up this separate entity that went in and was able to purchase debt from companies in America to alleviate some of their cash flow issues. So it's, a pretty standard approach. And that's a really important one to watch. So the refinancing quota for local government debt and the SPV potential for setting up an SPV is something that's really on our radar going forward, because local government debt issues have been around for a while, but are really starting to come to a head because of the slow growth over the past 2.5 years. So quick, now we're about to pivot to what's next. Before we do that, I do want to say, so we've lined out kind of where we are in the economy. There is potential for a cyclical improvement. We've lined out where the main policy, efforts are: consumption with a two-pronged approach, some efforts to bring marginal demand into the property market, and then efforts to deal with the most extreme stresses in local government debt. Now, I just want to say again, this policy framework has been developing for several months, but really the bulk of it has just come out in the past probably 2 months. And so officials are really looking to see whether this is going to continue working and or is going to work. And also just want to emphasize that policymakers, we keep hearing them say, we're pretty actually comfortable with the current trajectory of the economy. We think the recovery is coming. We're going to give our framework some time to play out. And so we think they'll largely stick to the course that we just laid out, maybe tweak some things, like we said, on the local government debt side, probably a few more aggressive things on the property side. But overall, the framework is there. And so I think that's important for a couple of reasons. One, it goes back to what we said at the top, which is the framework of when's the next shoe going to drop? The economy's terrible. When are officials finally going to panic? Is the wrong framework to have. Officials are pretty comfortable, and maybe counterintuitively from what we hear and read about China's economy from the outside. They're pretty happy with where they are, and they think their efforts so far are going to start to pay off in greater spades in the coming months. So that's where the headspace is, and that's why you're not seeing any significant stimulus. Another reason we're not seeing any significant stimulus is kind of a bigger issue. To dial back to the National People's Congress, the two sessions in March, what Xi Jinping did at that time was basically send a pretty clear signal through the government restructuring that structural issues are more important than cyclical issues right now. What I mean by that is when they restructured the government, they specifically restructured two important parts. They restructured the SciTech regulatory apparatus and the financial regulatory apparatus. And in my view, the signal to the system was very clear. What we need to do is unlock and focus on innovation and better technology and use our financial system to fund that. And that's what they have been doing, really focusing on economic policy wise, rather than cyclical upswings or downswings in growth. And so when you send that message, you're saying, we're going to focus on this. We're not focusing on the top line growth number, right? And so that's why officials are more focused on that aspect than trying to stimulate the economy. So that's kind of short term. Additional to that is, we, as many people will know, we're in a longer term transition away from just high growth rates to more equitable growth, to more sustainable growth. And this is part of Xi Jinping's shift away from, the reform and opening era, which in his resolution on history said basically is done, to now this new era of building a modern socialist economy or modern socialist country, which is about different goals. It's not just about the top line growth number. And so to put a finer point on it, Xi Jinping has said explicitly, strong economies are not economies that have the highest growth rates. Strong economies are the economies that have the best technology and the best innovation. And so that hopefully helps to put a little bit of put you in the head of where in policymakers' heads, they are just not focused on stimulus to hit an arbitrary growth number, way unlike they have been in the past. And so don't think about when's the stimulus going to come, when's the stimulus going to come. We've got the framework. They're largely going to stick to it. So now what's next? And we're already at 40 minutes, but we'll get through, we'll spend time on this. We will definitely take your questions and we'll let everybody go at the hour. But we're about to come up to a pretty significant several meetings that will focus on economic policy. Denny, can you walk us through what the upcoming meetings are, what people should be watching, the dates or at least general dates that people should be watching out for?
Absolutely. So there's 3 meetings before the end of the year. The first is the third and final of the Politburo's meetings on the economy. Now that's going to come up sometime before the end of October. Then we have the third plenum, which is typically on economic issues. That we are expecting sometime in October or November. Given that we don't have a date for it yet, I think it's fair to assume that's going to turn up sometime in November. And then the third one is the Central Economic Work Conference. Now that is the big get-together it's chaired by Xi Jinping, and it's a get-together of all the senior economic policy makers who get together to chart out the course for the economy, their vision for what the economy will look like in 2024. So in pretty quick succession, we've got 3 pretty high profile meetings on the economy coming up. The first one, in terms of the meeting of the Politburo on the economy, we're not really expecting from any of these a significant pivot. least of all this first one. As I said before, this kind of approach to dealing with boosting consumption in particular, which is kind of linked to whether the government stimulates or not, this idea of unlocking latent demand, putting more money back in the pockets of households, it's only really been in effect for maybe 5 months. That is not long enough for the government to kind of pass judgment on and abandon wholesale. I think, if anything, what we're going to see is an ongoing commitment to that particular approach. Now, that's not to say that we won't have meaningful developments from the Politburo meeting. At the last one, 2 very interesting things came up. First was this idea that there was going to be a basket of measures to deal with local government debt. And the other one, which no one quite recognised for its significance at the time, was this idea about needing to enliven the capital markets, which turned out to be a very big deal. But the point is, we can have significant new policy initiatives come out in this Politburo meeting without there being a pivot. But I think in the sort of the broader direction of things is they're going to stay the course, and there will be developments and mechanisms to kind of double down or further develop the approach that they've already taken. Then the next one is the plenum, and I'll throw over to you, Andrew, if you've got any thoughts on what to expect there.
Well, before I get into the plenum, the other thing I think to look at in the Politburo meeting is just the areas of emphasis. We've talked about, they've been pretty consistent. We need to focus on consumption, property, the capital markets was part of the consumption piece, and then local government debt. I think this Politburo meeting will give us a sense of what do we think's working and what's not. What do we need to kind of double down on? So the areas of emphasis will be particularly important. Do they mention more on the property market? Do they lean in and say, okay, actually, we are a little bit more worried. We need to do more, become more aggressive. Do they expand on the idea that we need to further expand our basket of measures for local government debt? Is that where their heads are focused? Or is there another piece that relates to consumption? I think that it will be important for us to get a sense of what they think's working and what's not based on what they emphasize in that meeting readout. On the third plenum, this is one where, in particular, like I just said, policymakers are not primarily focused on short-term economic growth. Traditionally, the third plenum does talk about big economic issues, but what we're hearing is that actually it likely won't be focused much on the economy at all. It'll may be focused on, personnel issues with, the developments around Qingdao happening, and the defense minister will probably get some clarity on their future. There will be likely more emphasis on kind of party development and efforts to deepen the party's reach within society, and ideological type things like that. So what we're expecting actually is that the third plenum will be an aberration from previous third plenums to say, actually, we're not that focused on the economy. And that would actually align with this bigger change of Xi Jinping saying top line growth isn't where our heads are at right now. Maybe they'll focus a little bit on the need to innovate, become scientifically and technologically self-sufficient. I would not be surprised about that. That would be in keeping with the big themes of Xi Jinping's governance for this year. So basically, I think we don't expect a ton of big signals economically out of the plenum, and that is a signal in and of itself. A further signal, we're just in a new phase of governance, and we are not focused on short-term fluctuations in the economy. So that, I think, will be, if we do get something more, explicit on economic matters, that will be kind of a bit of a surprise. But I think the signal actually is in what they don't say, which will be, actually, we're doing something different with this third plenum this year. So that's what we're expecting for now. Again, that's in keeping with, we're just assessing. We like our plan, and we're going to kind of tweak it here and there, but no major departures. Final thing will be the big Central Economic Work Conference in December, which does the planning for 2024 policy. What are you expecting out of that, Denny?
Look, I'd be surprised if there isn't a huge focus on local government debt. I mean, as I said, so far only over the last couple of weeks, we've only seen really the government, one explicit, real details about one of the measures in the Politburo's basket. I think we'll see more by the end of the year, but I think when you get all the senior policymakers together, that has to be a major focus of their attention. Of course, the other question that they'll be discussing about is where the growth target for 2024 should be. We won't find out officially until months later, but we might start getting a few leaks around that time. But ultimately, they're not going to. It'd be highly unlikely for them to post a faster growth rate for 2024. I mean, Andrew, what would you expect for growth for the coming year? I mean, how do you think they'd manage it?
Yeah, I think so. That cyclical momentum of the economy, month on month or quarter on quarter, will likely start to improve. It may be like bottoming out now, but I would be very surprised if they increased the growth target and said, we're going to try to grow for actually faster growth year on year next year. I think they are kind of trying to stabilize things. So I'd expect the growth target to basically stay the same, but I think that's important again, to say, the growth target at the beginning of this year was considered like a relatively low target, relatively at the bottom of the range that people were expecting. And people said, wow, they, seem to be just giving themselves an easy target. But actually, it turned out that they are kind of shooting for slower growth, or at least not trying to stimulate too aggressively to hit a higher growth number. And so a lot of people heard 5 in March and expected 6 or 7. But actually, this is a new approach where 5 means 5, right? And so even if they maintain the growth target, it's still a signal that we're really not pumping for aggressive cyclical improvement in the economy. We're going to take our time to let the measures that we are working on bear more fruit, and we're not going to do anything much more aggressive. I think so. I do expect local government debt will really, really, really be the focus. Last year of this December Economic Work Conference, last year it was really focused on consumption. That may continue to feature. It will, potentially, if the PBOC is right and we're sort of towards the tail end of the household balance sheet adjustment, maybe they'll be more comfortable with where consumption is. And so really focus in on that local government debt issue. But again, the key here is no massive departures. I think that does it. Well, for our back and forth here, Danny, we got a few questions starting to come in. Please, if anyone has any questions, send them through the Q&A. The first one here is on the PBOC. Do you think the PBOC could change the mortgage rate adjustment mechanism so that rates adjust every quarter instead of once a year, or link mortgage rates to a spread on 3-month SHIBOR rate instead of the loan prime rate to improve monetary policy transmission? That's a pretty technical question from someone, I believe, who works in a bank. And so sorry for some of the jargon there for folks, but basically the question is, can they adjust the mechanism so that monetary policy feeds through to mortgage holders more quickly?
They could. I mean, at the end of the day, I'm sure they could, but that, in sort of my reading, that hasn't necessarily been something that has been. Their concern hasn't necessarily been the pace at which the mechanism has kind of passed on to mortgage holders. I think they have been more concerned with ensuring that. Because I guess my point is that this approach to using lower mortgage rates to boost consumption is relatively new. This is the first time they've kind of really done it. So it's kind of a new thing. I'm not sure whether they've kind of considered it in a way of like, okay, well, maybe we need to sort of radically change the way that we manage the system in order to kind of ensure more rapid response to monetary policy. So of course they could. I think their main concern thus far has been very much about ensuring that mortgage rates drop as a way to kind of stimulate the consumption of new housing, purchase of new housing. I mean, that's been their overweening concern up until really the last few months. And I think here they've already introduced a huge amount of flexibility into the system. I mean, I think at the end of the last, at the time that the PBOC issued the last quarterly monetary report, something like 110 cities around the country had full discretion, were exerting full discretion over where they set the minimum monetary, the minimum mortgage rate. They weren't taking their marching orders from the PBOC anymore. The PBOC had effectively reduced the minimum, and 110 cities were taking full advantage of that. So yeah, in theory, what you suggested could happen, but I think up until now that hasn't been a major concern of the monetary authorities.
Great. Another question here, I'll jump in, but I know you have thoughts. Is any comments on the renminbi? I assume we're talking exchange rate there. I think, my view would be, and long has been, that renminbi movements are largely driven by dollar movements, and the dollar has been surging in the past few months, and that has primarily driven the depreciation of the currency against the US dollar. Many currencies throughout the world, most currencies have been depreciating against the dollar. I think we're now at a range where we will likely maintain kind of sideways movement-ish, 7.25 to 7.35. I think it's hard to see the dollar surging much more aggressively. Maybe the Fed hikes one more time, but likely is on an extended pause. I think the PBOC's approach here has changed over the past, basically since 2016, where they have allowed the currency, since they kind of had their mini deval debacle in 2015, have allowed the currency to vent more, as long as the currency movements are driven by general kind of fundamental market developments. And with China's economy struggling and the US economy still growing pretty strongly, US interest rates now above Chinese interest rates, of course the dollar is going to be stronger against the renminbi. What the PBOC does not want is speculative movements in the currency. It doesn't want the currency to become a one-way bet, and it doesn't want large positions speculatively either way. So it doesn't want large short positions when the renminbi is declining. It doesn't want large hot money inflows or long positions on the renminbi when the renminbi is appreciating. And so the PBOC's approach has been to try to slow the pace of appreciation, depreciation, make it expensive to short the currency, and basically keep speculators out of the market. And then has done some other things to intervene a little bit, again, to slow that pace of appreciation. So, but largely the PBOC seems to be comfortable with letting the currency generally go where it wants to, based on global financial developments. So I don't expect a ton more intervention, but I also don't expect a ton more intervention will be needed, because I think the dollar's kind of topping out, and the PBOC will trade at this relatively weak level for the next several months until the dollar potentially starts to fall if the Fed starts cutting rates in 2024. Denny, your thoughts?
No, let's just keep moving through the questions, Andrew. I think that was good.
What is your view on Xi Jinping's distributing power, i.e., is Li Qiang stronger than Li Keqiang? Denny, you got any thoughts?
Not really. I know some of our colleagues, I think, have taken a pretty strong position on this. I think they see Li Qiang, given his relationship with Xi Jinping and given his track record to actually having the ear of Xi Jinping, that kind of in this particular political economy does make him more powerful than Li Keqiang. Ultimately, it's not about the formal mechanisms or the formal accoutrements of being premier. It really comes down to how much latitude you have relative to Xi, and on that count, Li Qiang has more because he is a trusted lieutenant in a way that Li Keqiang never was. Anyway, I'm just kind of channeling some of our colleagues who are closer to this. But Andrew, any thoughts?
No, I think you nailed it. I mean, I always say that, people would always say, who's replacing Liu He, the former vice premier in charge of the economy, who was really the economic czar for the past 5 years at the expense of Li Keqiang, the premier. And, He Lifeng is the guy who officially replaced him with the economic portfolio as vice premier. But what I always say is actually, He Lifeng didn't replace Liu He, Li Qiang did. Right, Li Qiang is the new economic czar. He Lifeng still has, important decision-making power. But what we've basically done is restore what the balance is, or the how the mechanism is supposed to work, where economic decision making is primarily, put in the premier, not in a vice premier. And so this is how the system has worked in the past. Xi Jinping decided to neuter effectively Li Keqiang, and put trust in the guy, put his power in the guy he trusted, Liu He. I think the same thing's happening with Li Chang, and you're seeing more delegation on economic issues, which I think is a good thing. I think it goes to the broader question of, can Xi Jinping delegate? Are are the people around him all just yes men? And our team, particularly our team in China, has long argued kind of counterintuitively or against the common conventional wisdom that because Xi Jinping now trusts the people around him, he'll actually empower them, not officially in a way that would diminish his power, but allow them to do more on his behalf because he trusts them. So a lot of people thought, oh, they're all just yes men, nobody will speak truth to power. Xi Jinping will get bad information and will still micromanage. But it seems potentially the opposite is happening. He's also entrusting Tsai Chi with more meetings. And I know there's a bunch of conspiracy theories about, Xi Jinping's health, or this or that. They may be true, but and our read for now is that he is delegating more, and Li Chang is certainly a beneficiary of that. Question: do you think the upcoming third plenum will set the stage for Chinese authorities to present a package of reforms? I do not. I think we covered that to some extent. I think, like I said, this is going to be focused actually much less on the economy than the third plenum traditionally is. Denny, what's your bet on any economic reforms out of the third plenum?
No, I'm with you, Andrew. I mean, there's certainly scope for China to reform. I mean, everybody here, we watch very closely what kind of the ecosystem of policy recommendations around the government suggesting. I mean, that all the policy advisors, to the extent that there's any consensus these days, it's like there needs to be more to reduce the housing costs for migrant workers, boost income for migrant workers, boost access to public services. All of those sorts of reforms and all those changes, kind of fit broadly into Beijing's vision of kind of sort of its approach to kind of dealing with consumption issues. But if those are the reforms that are being advocated, right? If conceivably, if they're the ones on the cards, you don't need them to kind of roll out in the third plenum. If Beijing kind of goes, yep, this is the direction we want to take, then we could conceivably see that in the Central Economic Work Conference, because they broadly already fit into the framework that Beijing is taking. So we're not seeing any sort of discussion or debate or advocacy for sort of the big, pivotal reforms that you might actually get from a third plenum. The sort of the heaviest, most significant changes being advocated. We don't need a third plenum for the authorities to kind of to sort of take on board.
Yeah, I agree. One other thing I should have mentioned at the top, but I'll mention now, it looks like we've still got quite a few people in the room, is we will, for attendees of this webinar, Flash Talk, as we call them, we'll send through a discount for anybody who's not a current Neopol subscriber. Would love to have you all on as subscribers, and we'll send out a discount code for your first year of service just after or later today. We really appreciate everyone joining us, and would love to have you on board as subscribers if you're not currently. We're 1 minute to the deadline, and so there are a bunch of other good questions in here. I'm sorry we weren't able to get to them all, but please feel free to email us at hq@triviumchina.com, and we're happy to have a discussion around those over email. So sorry we couldn't get to them all, but we really appreciate everyone joining us today. I think it was a good, lively discussion, great questions. And Denny, thank you very much for your time today.
Of course, Andrew. Till next time.
All right. Thanks, everyone. Have a great day. Bye-bye.